Greetings, it is time for another monthly review of central bank activity and the connection between exponential monetary creation and technological deflation, like we do every month. So we go to our Yardeni balance sheet report. This is produced by Dr. Ed Yardeni and his staff, and this is their contact information if you ever want to call them. And we scroll down. These are the four largest central banks of the world: United States, European Union, China, and Japan. And you will consistently hear in the media that the United States is printing so much money and therefore there will be a rise in the price of gold because of the inflation. And that is just ignorant right off the bat, because the United States is only about 1/4 of the entire world's money printing, and gold and other commodities are priced worldwide, as we will see later in this video. So the notion that the money printing of one country will boost the price of some commodities is making a tacit assumption that the United States is the only country in the world. Another meme that people hear all the time is that Federal Reserve money printing destroys the dollar. How can it destroy the dollar when the United States is not really printing more money than any other currency that's out there? The biggest is the European Union with $9.7 trillion printed. The United States, the red line, is second. So all of these memes are very ignorant, and people who want to feel that they are financially sophisticated memorize a soundbite and repeat it, but none of those have any basis in truth. Now, as we know, technology is borderless and monetary creation is borderless. Therefore, the only thing that matters is the sum total of all central bank money printing. These four central banks are 85 to 90% of all the quantitative easing done in the world today. It's not 100% of it, but these four are the big salient ones. So what is the total of all four? Coming to figure 2, we see this grand total, and it's up to 31 trillion to date. And as you can see, this has been rising exponentially, as one would expect, because it matches technological deflation, which is also exponential. Technology becomes a larger and larger portion of the economy each year. Therefore, it generates more and more deflation. Therefore, the money printing needed to offset that deflation and maintain a baseline cruising speed, Goldilocks level of inflation, if you want to call it that, therefore rises exponentially. There was a time in 2011 where even $75 billion a month was more than enough, in fact, slightly above the ideal limit. But now in 2022, that number is $400 to $500 billion a month. So the fact that the Federal Reserve is tapering and is talking about raising interest rates is very misguided, because the stock market will correct and then they will just have to do more money printing than they were ever doing before. They've already done that 5 times, yet they keep repeating the same mistakes. Why? Because they think that the textbooks that they memorized from the 1950s are the fundamentals of economics and there is no new knowledge that could ever occur. But as we know very well, the definition of insanity is doing the same thing repeated times and expecting a different result. And we'll talk about that later in this video as well. So this is the gradient of cumulative money printing. And remember how I said that March 15th, 2020 was the Netscape moment of economics, and the 2010s decade had $23 trillion of money printing. But the 2020s, starting from January 1st, 2020 to December 31st, 2029, 10 years, would have about $100 trillion of money printing if done in a bond buying type of way. Maybe 50 trillion if it were in the form of cash sent directly to people, which is what I advocate, but if it were done in bond buying, it would be 100 trillion. And the first 2 years of that period that I mentioned have already seen about $12 trillion done, and therefore my prediction is the one that is on track. Now, what is the annual percentage growth rate? That is what's important. So we go down to that chart. Now, as you can see here, the annual percentage growth rate has been within a band in the low teens with a few distortions. The COVID-19 crisis got cumulative money printing all the way up to a 46% year-over-year growth rate, but that was just offsetting this negative growth rate of before. So it didn't change the band by any amount at all. And now we're down to just 8.5% year-over-year growth. So all the chance of high inflation that everyone was worried about from all the COVID-19 related stimuli, that is in the past, because that was almost a year ago that this number peaked, and now it's down to a rate that's below the optimal band. I say this should always be between 16 to 24% a year, just to offset deflation. If it went above 24%, that could cause inflation, and it did go above that briefly, but as we will see later in this video, the inflation effect was very muted and very delayed, and that's going on a little bit right now, but it is so muted that it's not a historically significant event. It's something people will forget about by April, May, June, when all of that brief inflation blip has moderated because of the shortage of new liquidity that we see here. 8.5% year-over-year growth is too little. Fine, maybe it's offsetting this unusually high peak, but that peak was offsetting this reduction over here. The band has to stay within 16 to 24% as per my atom thesis, which some of you are familiar with, and those of you who are relatively new to this channel should look at that both on this channel as well as the text version that is on the web, and that'll be in the description box below. Now, on the subject of how the US media seems disproportionately scared about money printing, and you have all sorts of pundits who have predicted inflation so many times, whether they are PhD economists or whether they are so-called money managers like Peter Schiff, they have all predicted about 100 of the last 0 bouts of hyperinflation, and they have been wrong every single time, and that doesn't stop them from repeating the same thing because they've memorized a certain thing. And in addition to that, the point of how the United States is seen as the only country in the world where money printing matters, so we're going to debunk that as well. You hear all this screaming how the US Federal Reserve printing money will cause inflation and will cause gold to go up. But here, in proportion to the GDP of the country in question, the United States is actually one of the lowest. US money printing has only been about 35% of US GDP. And this is cumulative money printing over many years, where GDP is an annual metric. But the United States is at 35%, whereas Europe is twice that amount, almost 70%, and Japan is 4 times that amount at 134.6%. So Japan has done 4 times as much QE in proportion to the size of its economy as the United States has done. Yet nobody claims Japan has high inflation. Even the people who claim the United States is already in hyperinflation, they don't claim that Japan has high inflation, and therefore they really don't know what's going on. If they say United States money printing is going to cause hyperinflation, but Japan can print 4 times as much money and there is no aberrant inflation in Japan, they don't know what's going on. Their entire premise is flawed, and they have been exposed as a complete charlatan in terms of their supposed expertise. So Japan has called the bluff of the notion that money printing can cause inflation. Now, remember, the other reason this has not occurred is that Japan's QE spills outside of Japan's borders and goes over the whole world. As we just saw a few minutes ago, the only metric that matters is the worldwide total, because technology is borderless and monetary creation is borderless. Therefore, only the worldwide total matters, because the accelerating technonomic medium, the atom, the collective force of all technology in the world, being borderless, absorbs quantitative easing, and the United States could, in theory, stop all QE and just draw from the QE of other countries. That would cause some distortions in currency exchange rates, but much more muted than one might expect. Japan has done 4 times as much QE as the United States relative to the size of the economy. And Europe, the people who are supposedly the most afraid of inflation, they have done twice as much as the United States. The US is at the bottom over here. And yet the US has the greatest number of fearmongers screaming about how hyperinflation is about to happen tomorrow. It's truly absurd when you think about it. But the US Federal Reserve is full of some of those people, and while they're not as fanatical as some of the others who say there should never have been QE, the US Federal Reserve is about to clamp down quantitative easing and raise interest rates, which is going to be another disaster, just like the last 5 times they did it, and they will be forced to reverse track and do more QE shortly thereafter. While they all believe that interest rates are going to be high by 2024, a 3% Fed funds rate, I guarantee that the Fed funds rate will still be 0, and that they will be doing more QE than they are doing even now. This is a CNBC article, and they say that the Fed will aggressively dial back its bond buying and sees 3 rate hikes next year. Now, every time they try and hike rates, they are forced to quickly reverse it. And I have said years ago, more than 6 years ago, I said the Fed funds rate is going to be 0 pretty much forever. Any small increase they do has to be quickly reversed, and that has continued to occur. But they just can't learn because they are still in a 1950s model, which was a pre-technology economy in terms of technological deflation. So the Federal Reserve is not only going to reduce its quantitative easing by 30 billion each month, in that it was 120 billion per month in November, which just ended, but now it's going to be 90, 60, 30, and 0, and pretty much done by April, as they're saying, and then they will start to raise rates, and they think they will do 3 rate hikes next year. They have learned nothing. This is the 5th time they're going to try the same thing of thinking that a Fed funds rate of 2.5% or 3% is normal. And the word they actually use is normal. They talk about normalizing interest rates. They have a dot plot in which all the Fed governors vote on what they think the long-term Fed funds rate is going to be, and they all are completely wrong, and I discussed that in this video up here. They all think it's 2.5 to 3%, and almost none think it can be zero forever because they think that 3% or 2.5% is normal. Why they think that? Because they don't understand technology, they're not curious about anything, they're not held to account, and a PhD economist is, in relation to the real financial world, what someone who reads about doing surgery is to a real surgeon. And even that is being generous to the PhD economist. They are super theoretical people. They don't understand what a prediction is. They think that talking about the past is the same as making a prediction. And I discuss that in this video up here, where a very well-known economist talks about the past and thinks he's making a prediction. And there's nothing specific to him at all. He's just doing what all economists do. They have no concept of what a prediction is. So the Federal Reserve thinks they're going to be able to pull this off. Luckily, I am creating these videos that archive all of this. They will, for the 5th time, be embarrassed and will be forced to reverse. And I guarantee that 2 years from now, the world will be doing much more QE than it is doing now. And among the world, the US will also be doing more than it is doing now, contrary to the dot plot forecasts that these Federal Reserve governors and all the PhD economist theoreticians who surround them say. They have no understanding of technology. They have no curiosity about the economics of technology. And they are far more afraid of inflation and far too unafraid of deflation than they should be because they know nothing about the real economy. Now, it sounds funny for me to say that people with PhDs in economics from the best schools know nothing about their own field, but historically that has happened many times before. In 1901, as late as 1901, the establishment in mechanical engineering was certain that heavier than air flying machines were not possible because they'd all memorized the same textbooks. Then someone actually went out and produced the machine, and these people said, oh, after the fact, sure, that makes sense. But they were never, ever willing to own up to how their orthodoxy simply had siloed all their knowledge and forced them to memorize outdated information. And they created an incentive structure within their own profession where young people could advance in their careers only by memorizing the outdated information. And that is what's happening here in economics as well. And I talk about that a lot on this channel. But why are they acting this way? Because a couple of months have an inflation reading that they think is high, but even that is wrong. They're reacting to the imaginary notion of inflation when, in fact, there is not any aberrantly high inflation as per what you should really look at, which is commodity prices, but even as per their own CPI index. Now, what is the most recent inflation rate? Tune out all the noise that comes out from the media, because the media has to not only fill a volume of time every day, but the media makes money by making you angry or frightened. And the media doesn't know enough about why deflation is bad. Otherwise, they would scare you about deflation as well. But they don't know enough about that because they've only memorized what these PhD economists have compressed into sound bites for them, which the media can take and run with. So what is inflation actually at? For that, we go to part 2 of this video. Now, if you're looking at the mainstream media right now, you see inflation being mentioned virtually everywhere. They would have you believe that we are currently in a phase of extreme hyperinflation that is going to impoverish everyone, and everyone is getting poorer by the day. And I'm here to tell you that nothing could be further from the truth. Remember that the media is in the business of making you either angry or frightened. The economics of the news media are around the incentive structure of making you anxious, frightened, angry, and a whole bunch of other negative emotions. They make a lot less money when they make you feel good. That's why inflation is an extremely useful tool for the media, because they like to scare people about how inflation is making them poorer and poorer, and they have to pay more and more for everything, yet their income is somehow not rising, and that is also not true. In reality, deflation is far worse for most people than inflation, as I describe in this video up here that you can see in the upper right-hand corner. But as you also may recall, I have created a metric of what defines truly structural inflation versus just short-term noise level data. The metric that I use to measure inflation is this 3% condition that I describe in this video up here that you can see on the right-hand side of the screen. And if you refer to that video, you'll see that I require that the 10-year compound annual growth rate of the US CPI to be 3%, and the 10-year compound annual growth rate of the Goldman Sachs Commodity Index also has to be 3%. Unless both of these are true at the same time, we do not have a structural inflation problem. All these people claiming that we have extremely high inflation are very easily debunked. One of the worst purveyors of this, at least on YouTube, is this Economics Explained channel, which I debunk in this video up here that you can see on the right-hand side in that tag. He claims that we are already in hyperinflation, and he made that video almost a year ago. Now, the definition of hyperinflation is 50% inflation per month for a sustained number of months. 50% per month, not even per year, per month. And that channel keeps doubling down on this hyperinflation narrative because he doesn't really know anything about economics. He probably has a degree in economics from a university, which by definition means he knows nothing about economics, because what is taught in universities has absolutely nothing to do with the new economics of technology. It may have had something to do with 1950s era economics. So onto our metric over here. The inflation threshold of the CPI has to be 3%, so we go to that first. So for that reason, we go to the Bureau of Labor Statistics website. So here we are at the Bureau of Labor Statistics website, and we go to Consumer Price Index like we do for every month. And to select the data that we properly want to see, we go to More Formatting Options, and I choose 2-month, 3-month, 6-month, and 12-month percentage change among all of these. So this is the 1-month change, and you can see it's already plateauing and flattening out. This is at a higher level than before, but it's not rising further. So the second derivative has already been erased a long time ago. But this is very noisy because this is the 1-month data. So the 2-month data, slightly less noisy, also coming down and plateauing. 3-month data has also not been able to rise beyond its initial bump up here. And the 6-month data is over here, plateauing again like all of the other ones. So only the 1 year over year data is what you see in the headline news, which still seems to be rising, but the internals of that are weakening because even at the 6 months level, this is not increasing very much. So what is the 10-year compound annual growth rate? So to calculate the 10-year compound annual growth rate of the CPI like we do every month, we follow the same process. Take the most recent reading, which is around 280, and take the one from 10 years prior exactly, which is 227. This is exactly 10 years ago, so the growth rate between the two is what we measure and then what we divide into an annualized compound number. So 280 divided by 227 equals 1.233. That means there has been 23.3% inflation over 10 years. Now what is it over 1 year? So you take the 10th root of this, 0.1, 1.0212, and what you do here is you subtract 1 from this and then multiply it by 100 to get the percentage amount, 2.12. So 2.1% compound annual growth rate of inflation over the last 10 years. That is about 0.1% higher than it was a couple months ago, but still nowhere near 3%. So 2.1% is the compound annual growth rate of the US CPI over the last 10 years. And most of the months that have a higher reading are already behind us based on what we saw from the second derivative just a few minutes ago. And I guarantee for that same reason that by April, May, June at the latest, you will see this number moderate back down, and all the people who are screaming about the CPI being at a 40-year high and all the very cherry-picked and very super selective statements that they make that give you no context about the actual trend lines or anything will all completely vanish. So 2.1%. Now, remember, the US CPI is a metric of only the United States, of only one country, and the United States does just 25% of the world's quantitative easing. The other 75% is not done by the United States. So this whole narrative of how the US Federal Reserve prints money, therefore a commodity like gold will go up, a commodity that is priced worldwide, is just so incredibly ignorant that I'm surprised how so many otherwise intelligent people, such as Peter Schiff, is just completely repeating something that is illogical even in its opening glance. Therefore, what we look at as the true worldwide metric is commodities, so we go over there. This is the Goldman Sachs Commodity Index, which includes oil, gold, copper, natural gas, and everything else that you would consider as a commodity. At the top over here, you can choose its 10-year growth rate. Now, remember, its 1-year growth rate may seem extremely high, 36%. But what is special about that starting point? We are looking at the 10-year growth rate. And the 10-year growth rate is still minus 0.99%. It is in deflation. It has been in deflation for a long time, but the 10-year annual growth rate is not even growth at all. It is 1% a year of deflation. And the commodity index is the most accurate because it is the purest measure of inflation, in that commodities do not have a labor component. They're the ingredients of everything else. They're priced worldwide. People who say that the US CPI is rigged somehow or is underreporting the real inflation for some reason are completely nullified and rebutted by use of the Goldman Sachs Commodity Index, because these are the prices of commodities that are actually traded, and they're traded worldwide. The price of oil is a worldwide commodity if used under Brent oil. Gold is priced worldwide. So many of these other commodities are priced worldwide, and therefore this is the most unriggable index and the purest indicator of whether we actually have structural inflation or not. Now, services are not included in the commodity index, but services are in a gray area of whether they comprise of the pernicious type of inflation or not, because service price increases are simultaneous with wage increases as well, whereas commodity price increases are indisputably a cost to all consumers. So minus 0.99%. So much for hyperinflation. This is not even inflation at all. It is deflation. So this takes us back to our 3% comparison table. So the US CPI 10-year compound annual growth rate and the Goldman Sachs 10-year compounded annual growth rate. And therefore, what we have just seen is that as of today, January 13th, 2022, use the US date convention, but hopefully everyone can figure out this is what I'm referring to. January 13, 2022, the US CPI is at 2.1% compound annual growth rate. It has edged up a little bit, but still nowhere near 3%. And the Goldman Sachs Commodity Index is still in deflation. Only when both of these numbers are crossed at the same time will I say that, yes, there is a structural inflation problem. If only one of them is crossed and the other is not, even that does not qualify. Both have to be crossed at the same time for reasons I described in that video that I had the card for. And we are still nowhere close to this. The US CPI has edged up a little bit, but as I said, it's going to edge back down very shortly, especially since the Federal Reserve has already started its tapering program, which affects the US because it's a US-only CPI index. So this is what the story is about inflation, and this is the most recent monthly report. Tune out all the garbage that you see in the media about how inflation is making everyone poorer and how one particular product rose so much in price, therefore we are living in hyperinflation. All these PhD economists are super theoretical people, and when they say that quantitative easing causes inflation, there's just so many things wrong with that in terms of assuming that one country is the whole world, as well as how one product category represents all products, because they always cherry pick the one that rose and ignore the ones that didn't rise. And they foster a culture of ignorance and hearsay where just because their mode of thinking is that, hey, my wife's boyfriend's parole officer heard that the price of something rose, therefore there must be hyperinflation. They're trying to foist that type of very loserish mindset onto other people, and you should resist that because these are the last people you should ever be listening to. They're hyper theoretical and have no connection to the real world in any sense and don't even know anything about their purported primary field. So that is where we are in terms of the state of inflationary pressure, or lack thereof, as we're just seeing, and how technological deflation, which is rising exponentially, continues to hack away at the price of not just commodities, but also services to a lesser extent. And I'm going to have a future video at some point about the hierarchy of inflation purity, how commodity prices are the purest measure of inflation, service prices are an imperfect measure of inflation because service price inflation also increases wages as well, and therefore while some people are losing from service price inflation, some people are not. But that's why we take both of these metrics, a US CPI and a Goldman Sachs Commodity Index. If there were a worldwide CPI metric, that would be the better one to use than the US CPI metric, but there isn't one that is as widely used, so we use the Goldman Sachs Commodity Index as the ultimate worldwide indicator, particularly because commodities are the purest indicator of inflation or lack thereof. Anyway, I hope you found this monthly update to be informative. And if you like this type of content, I encourage you to subscribe to this channel. Thank you very much for watching.